Have you ever wondered how professional traders and institutions enter the market before massive price moves happen? What if you could identify the exact zones where smart money, like banks, hedge funds, and institutions, are placing their buy and sell orders? That is exactly what you'll learn in today's video. Today we're covering one of the most powerful smart money concepts: what order blocks are, why price reacts from them, how to identify valid bullish and bearish order blocks, how to enter trades using them, and most importantly, how to avoid fake order blocks that trap beginners. So make sure you watch this video till the end because the last section will save you from a lot of losing trades. Let's get started. What is an order block? First, let's understand the basic idea behind an order block. An order block is simply a price zone where large institutions have placed huge buy or sell orders. Now think about this logically. Retail traders like us might trade with small capital, but institutions trade with millions or even billions of dollars. They cannot enter all their positions at one single price. There simply wouldn't be enough buyers or sellers available. So what do? They spread their orders across a price range. And when these massive orders enter the market, price moves aggressively. That aggressive move leaves a footprint on the chart. That footprint is what we call an order block. So whenever you see a strong impulsive move, a large momentum candle, sudden increase in volume, there's a high chance smart money was active there. And later when price comes back to that same zone, the market often reacts again, because institutions may still have unfilled orders sitting there. Bullish order block explained. Now let's understand a bullish order block. Imagine the market is moving upward. Then price makes a small correction or pullback. After that correction, suddenly a huge bullish candle appears. That large bullish candle is called a momentum candle. Now remember, retail traders usually cannot create such massive candles. These moves are usually caused by institutional buying pressure. So here's how we mark the bullish order block. You take the candle just before the momentum candle. Then mark the high of that candle and the low of that candle. The entire zone between those two levels becomes your bullish order block. This zone represents institutional buying activity. Now here's the important part. When price later returns to this zone, there is a strong chance buyers will step in again. That's where we look for buying opportunities. Fair value gap confirmation. Not every order block is valid. A high-quality order block usually has something called an FVG, a fair value gap. A fair value gap is basically an imbalance in price delivery. It happens when price moves so aggressively that a gap is left between candles. Here's how you confirm it. After the momentum candle forms, look at the next candle. If the next candle does not fully overlap the order block area, a small gap remains. That gap is the fair value gap. And this is extremely important because it shows strong institutional aggression. The stronger the imbalance, the stronger the order block usually is. How to trade a bullish order block. Now let's talk about entries. Once you identify a bullish order block, don't chase the market immediately. Wait patiently for price to return to the zone. When price revisits the order block, watch for bullish rejection, increased volume, strong bullish candles, or lower timeframe confirmation. Then you can enter a buy trade. Your stop loss should go slightly below the order block, and your target can be previous highs, liquidity zones, or a risk-to-reward ratio like 1:2 or 1:3. This gives you tight risk management with potentially large rewards. That's why smart money concepts are so powerful. Now let's understand the bearish order block. This works exactly opposite. Suppose the market is moving upward. Then suddenly a huge bearish candle appears after a small pullback. That strong bearish candle suggests institutional selling. Now again, mark the candle just before the momentum candle. Draw the high and the low. That zone becomes your bearish order block. When price later comes back to this zone, there's a strong probability sellers will enter again. This becomes your short selling area. Your stop loss goes slightly above the zone. And targets can be previous lows or liquidity areas below. Why order blocks work? A lot of beginners ask, why does price react from order blocks again and again? The answer is simple. Institutions rarely get all their orders filled in one move. So when price revisits that area, their remaining limit orders get executed. That creates fresh demand or supply. And price reacts again. This is why order blocks often behave like support zones, resistance zones, high liquidity areas, but with much more precision. How to identify valid order blocks. Now this is the most important section of the video, because this is where most traders fail. Here are the conditions for a valid order block. 1. Strong momentum move. The move away from the zone must be aggressive. Weak candles usually mean weak institutional activity. 2. Fair value gap must exist. A proper imbalance or FVG should be present. No imbalance usually means low quality setup. 3. Order block should be unmitigated. This is very important. If price already returned to the order block and reacted, then many institutional orders may already be filled. That weakens the zone. Fresh order blocks are usually stronger. Risk management. One more important thing. Never rely only on order blocks. Always combine them with market structure, trend direction, liquidity, volume, and proper risk management. Even the best setups fail sometimes. Professional trading is not about winning every trade. It's about managing risk and staying profitable long term. If you enjoyed this video and learned something valuable, make sure to like the video and subscribe to the channel. And comment below if you want the next video on.